be long. It's kind of a typical thing. So the angle and the crossover points are moving averages are kind of the key. The other indicators that we have there, we have down below, that we have the predicted differences, as they're called, the predicted differences, the blue line and the green line down there. The blue line represents the difference between a predicted moving average and an actual moving average for a medium-term period, the green line for a long-term period. And you have some of those moves back and forth. When you look at that currently, you can see it is below this zero line, and it looks a little bit on the weak side, but is rather mixed as it kind of chops around back and forth. So we'll talk about that indicator as an overall kind of a tone of the market that sets the pace. And then we have the Neuro Index that you see at the bottom, and that Neuro Index is currently at 0. That is a comparison of 2 3-day moving averages, and when it does compare 2 3-day moving averages of the typical price, I should clarify, that's the average of the high, the low, and the close. And it indicates, if the reading is 0, that indicates it will be lower in 2 days than it is today. If it is on a 1 reading, it will be higher. So you have those indicators that kind of tell you the tone and the preferred direction of the market, if you want to look at it in that standpoint. Then we also have the predicted high and the predicted low. There are some other indicators that are, available of this type of nature to set up channels and so forth, but this is kind of a unique feature of Vantage Point because it shows you what the predicted range will be, the predicted high and the low will be for the next day ahead, as you can see on the far right edge of the chart. The predicted high is that gold line across the top. The predicted low is that pink or fuchsia line, if you prefer, that across the bottoms. And we have kind of a strategy set up, but when you look at this last 2-month period, you can see how it has chopped back and forth. Where are the trends? If I want to be a trend trader or even a swing trader, where am I going to build on some trends here that will help me get in and get out without taking so much risk or getting chopped up by the small profits and then the risk that I have to take. And so you have to look at the time frame perhaps and maybe shorten it up and go to intraday trading. Now that's, as I say, not a preferred route that a lot of people will want to go. It's not for everyone. It won't be working, great every day, and you can get chewed up in this way as well as you can with almost any other method of trading. But we're going to put out some ideas for intraday strategy that might work for traders who are nimble and flexible and capable of, working with a shorter-term time frame within a single day. This is kind of a zooming in further. We're only going to take a couple of days at a time to explain the strategy, in more detail and just look kind of one candle at a time. Now you have to remember that when we're talking about the end of the day on this particular day, what we have right here, when we look at that candle, we have this information. It reads that we should be they're reading a neural index at 1, so it should be bullish, and the predicted difference is that is moving up, and we still have that kind of battling against the effects of this predicted moving average being below the actual moving average, which is bearish. So you have those cross currents that are going on. But overall, when we set it up, we do not have that candle that I have marked all up there available to us to be able to see, what is going on there. We can't really say, well, what's the high or what's the low? Well, we don't know because we only have a predicted high and low. The basic premise of the strategy that we're going to talk about is to fade the Vantage Point predicted highs and low. Now this assumes, of course, that the prices will generally stay within the confines of the predicted range. And I know I said there are other channel types of techniques that you can use. Pivot points can be used in the same way. But you have to have some way to forecast the next day's possible range. What are the probabilities based upon previous pricing, previous volatility, and what's the probability of the range for the next day? Then what you need to have is you have to have that open. It needs to be somewhere in the middle of that range. This particular case here, we're dropping back to September 28th to kind of give you an idea of what is going on in the last few days. I don't want to go back and cherry pick some perfect time from the past, but I want to show how does it work on current market situations and whether this would be a trading possibility or whether it would not. The open, as I said, should be somewhere in the middle of the trading range. In this case, the open was in the vicinity of 1169. It depends a little on the source that you have for your data and the open as to when it is, because there a little different because you have a 24-hour market type situation. I'm using the E-mini, and it's primarily because the E-mini that I find, you have a market that goes up, that goes down. You can trade either, long or short fairly easily. I don't use it so much on stocks because, for one thing, the stocks kind of tend to jump around a little bit. If I'm trading them, I tend to look at it more from a one-way standpoint. I want to be a buyer because it seems too complicated to be a seller, and I know that probably is the way most traders look at it, and probably should not. But we look at stocks pretty much as a buy-side only situation. In this case, we're going to talk about an E-mini, which can just as well go down as go up, and we can trade it either way. I'm going to use a rather arbitrary 4 points as the entry criteria. There are several ways to enter the trade, but to explain that, the average daily range has been, as you know, rather wide recently. And I'm going to say that, just rounded ballpark figures, it has been 40 points in the E-mini on an average day. Now, it's sometimes more, sometimes less, but we're going to use that. I want to use 10% of that range for my fade effect, and that is 4 points, either from the predicted high or from the predicted low. I'll give up that 10% because I know I can't get the exact high, the exact low. I'll give up that 10% because that still leaves a pretty nice large chunk in the middle of the predicted range that I can trade. So, as I said, when we look at this situation, we kind of would have preferred that the market be ready to be a little on the bearish side. We would prefer that side simply because our indicators are more on the bearish side perhaps than not. It depends a little bit on where you put the most emphasis. Now, you need to know where the predicted high was when you have that, and the predicted high for this particular day, September 28th, was 1181. And when you look at 1181 minus 4 to get our sell area, we would sell on a limit order at 1177. The same thing on the downside. We have the predicted low here that is at 1155, and we would then add 4 points to that. We would fade that low and be a buyer at 1159. Now, there's no guarantee that you're going to actually hit that exact price area. Again, that's why I say originally, when you have to be very nimble, you have to be flexible in how you're going to trade this market. When you look at this market, the predicted, we know that we're in the middle of the range when we opened at 1169, which is what we want to be. But the key here is, of course, how does the market flow during the day? And for that, we're going to turn to an intraday chart, and that is going to be a E-signal chart. I can take my lines from my predicted high and lows, mark them up on an E-signal chart, come up with my key points as to how I would potentially trade this market from an intraday standpoint, and look at how the action played out on September 28th. The open at